Let's talk about $1 trillion. Seriously, $1 trillion. Today, we're diving into a massive, highly discussed explainer by creator Dhruv Rathi. He breaks down the absolute mechanics behind a 12-digit net worth. Specifically, we're looking at the projected June 2026 SpaceX IPO that officially crowns Elon Musk as the world's first trillionaire. We're going to get into the market mechanics, the financial loopholes, and the alleged political maneuvering that actually makes a staggering milestone like this possible. Let's get right to it. But okay, before we talk about exactly how it happened, we really need to pause and visualize just how massive 12 zeros actually is. I mean, we hear million, billion, and trillion thrown around so casually these days, right? But human brains just struggle to process a number this gigantic. To put it into perspective, if you spent $1 million every single day, it would take you over 2,700 years to run out of money. It's just wild. This source video uses these brilliant time analogy that I absolutely love. Think about it like this. Going back 1 million seconds puts you at just about a week and a half ago, okay? 1 billion seconds, that's roughly 32 years ago. But 1 trillion seconds, that places you 31,000 years in the past. We're talking long, long before human civilization as we know it even began. That is the true mind-bending scale of $1 trillion. And this staggering scale means this one single valuation makes one man richer than the combined wealth of the founders of Google, Amazon, Oracle, and Facebook, put together. It's a concentration of wealth that literally outpaces the GDP of most nations on Earth. So we have to ask, what is the real story behind this massive number? So that brings us to Section 1, paper wealth versus cash, and the illusion of liquidity. You know, we tend to think of $1 trillion like a giant Scrooge McDuck vault of cash you can just swim in. But modern extreme wealth is fundamentally different. This money is definitely not sitting in a checking account ready to be spent. In fact, Musk himself has stated he holds only about 0.1% of his wealth in liquid cash. The other 99.9%, that is fragile paper wealth, entirely tied up in shares of companies like Tesla and SpaceX. It's essentially just a number on a screen, totally dictated by the mood of the stock market. And the explainer points out that this setup is incredibly fragile. If a billionaire actually tried to cash out and sell their massive amount of shares to get that $1 trillion, the sudden flood of stock would cause the market to completely panic. I mean, investors would assume the worst, right? And that triggers a huge sell-off. In an instant, that paper wealth would collapse like a house of cards. It exists largely in theory, heavily dependent on market perception rather than liquid, spendable reality. Which leads us directly into Section 2, selling castles in the air, or basically selling sci-fi dreams. So, if the wealth is based on share prices, how do those prices get so insanely inflated in the first place? Well, the source brings in economist Burton Malkiel, who outlines two theories of stock valuation. First, you have the firm foundation theory, which bases a company's value on strict, tangible fundamentals, actual revenue, profits, physical production. But the argument made here is that Musk's companies are valued on what's called the castles in the air theory. Investors aren't really buying current profits. They're buying into massive, world-changing dreams and the psychological hype of the future. Just look at the actual math for a second. Leading up to this valuation, SpaceX actually incurred a $5 billion loss in 2025. Because of this, independent research firms like Morningstar valued the company's true worth at only 35 to 40% of its $2.2 trillion market hype. The basic financial fundamentals just don't support the $1 trillion tag. The valuation is clearly driven by something else entirely. The source argues this castles in the air valuation is achieved by repeatedly selling incredibly ambitious sci-fi concepts that totally capture the public's imagination, regardless of whether they actually get delivered. And there's a pretty clear pattern outlined here. The Hyperloop was announced in 2013, but ended up winding down a decade later. Mars colonization was promised in 10 to 12 years back in 2014, fully autonomous Teslas were promised in 3 years back in 2015, and 1 million robotaxis were promised by 2020. The psychological hype successfully inflates the stock far more than actual delivered results do. And this detachment from reality has drawn some heavy skepticism from major Wall Street players. The video highlights Steve Eisman. You might know him as the famous investor from The Big Short, who predicted the 2008 housing crash. He doesn't describe the SpaceX IPO as a traditional financial event at all. Instead, he calls it an IPO of a sci-fi story, tailor-made for a sci-fi cult. It really represents a deep detachment from traditional financial reality. All right, Section 3, buy, borrow, and die. This is the billionaire tax strategy. Okay, so if the money is all tied up in fragile stocks, how on earth do the ultra-rich actually fund their lavish lifestyles without ever cashing out? Well, the explainer breaks down a very specific, entirely legal loophole known as buy, borrow, die. It works like this. Step 1. Keep your wealth locked in shares to avoid income tax. Step 2. When you actually need cash, mortgage those shares to banks in exchange for massive low-interest loans. And since it's a loan, it isn't taxed as income. Then, step 3, hold these assets until death, passing them to your heirs under U.S. tax rules that often wipe out the tax burden entirely. It's a wildly effective strategy. And we can actually see this exact strategy in action with the purchase of Twitter. The source claims Musk didn't just sell off billions in stock and pay the massive taxes on it. Instead, he reportedly mortgaged $62.5 billion of Tesla stock to secure a $12.5 billion cash loan. By doing this, he successfully accessed billions in cash while legally sidestepping basically any income or capital gains tax. The video strongly argues that this loophole creates a systemic, massive societal disparity. From 2014 to 2018, Musk's effective tax rate relative to his wealth growth was calculated at just 3.2%. Think about that for a second. Compare that 3.2% to the 20 to 30% you or your neighbors likely pay out of your hard-earned paychecks every single year. The system is just built completely differently at the top. Moving on to Section 4, politics and rule changes, and the concept of lobbying for wealth. Now, market hype and tax loopholes are one thing, but the explainer asserts that the final, critical ingredient to securing a trillion-dollar valuation is political facilitation. Essentially, immense financial contributions can directly pave the way for highly favorable corporate treatment. The video reports that following a massive $290 million campaign donation to Donald Trump, Musk's net worth dramatically multiplied by 5 times during the presidency, aided by an administration that, they argue, actively shielded his corporate empire. And the explainer outlines a staggering list of unprecedented regulatory shifts to back this up. For instance, NASDAQ changed rules to allow SpaceX a fast entry with just a 15-day waiting period. The SEC granted broker waivers literally 2 days before the IPO that put $70 billion of customer funds at risk. The FCC granted SpaceX control over 2/3 of all low Earth orbit satellites. And on top of all that, 40 pending investigations and court cases were suddenly dropped. And these political connections definitely have a global reach. Look at the remarkably rapid approval of Starlink in India that the video highlights. High-level diplomatic meetings between U.S. and Indian leadership took place in February 2025. By April, Modi and Musk were on direct phone calls regarding national security conditions. And then boom, by June, Starlink had its satellite internet license. It really illustrates how political leverage acts as a massive multiplier for corporate growth. Finally, Section 5, the real-world cost. This is where we look at extreme wealth versus global crises. When we zoom out, the explainer forces us to contrast this manufactured, politically insulated wealth with truly urgent global needs. According to data from the UN World Food Program, completely eliminating world hunger would cost about $40 billion a year. Let that sink in. That is a mere 1/25th, just 4% of the paper wealth attributed to just one individual in this trillion-dollar IPO. Furthermore, an analysis from Oxfam that's cited in the video calculates that if a mere 10% tax were effectively imposed on this level of extreme wealth, the revenue generated could fundamentally alter the lives of 800 million people currently living in extreme poverty. The explainer frames this accumulation of paper wealth not just as a financial victory for one person, but as a massive, tangible lost opportunity for global progress. Which leaves us with a really profound final thought, based on everything we've covered from the source. If just a fraction of this highly engineered paper wealth could literally solve the greatest global crises of our time, why do we maintain a financial system that rewards castles in the air and political favors over fundamental reality? And ultimately, if the market truly relies on unfulfilled promises, who is going to pay the price when reality finally catches up? Think about that for a bit.